Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. On a day when the US CPI came in better than expected and the stock market in Wall Street really liked it and our market liked it as well. I'll be exploring with Marcus Bogdan of the Switzer Dividend Growth Fund and Blackmore Capital what he thought about the number and how he's going to invest as a consequence of it. And then I'll talk to my colleague Rickard about the number as well and how he thinks the market will respond, not just today, but in the near future and also longer term. Is this ultimately a sneak preview of the good stuff that lies out there if inflation can keep coming down and as a consequence, less interest rate rises than has been expected in the past? And then we talked to the senior economist at PropTrack, Eleanor Creagh, who actually is basically an employee of REA. REA owns PropTrack. And REA reported well this week. This is a company that we've been telling you is a good quality tech company, was likely to be a beneficiary of the potential lower interest rates and the fact that tech will probably be reloved again. It's done well over the last month or so. But I also wanted to ask her, what happens to actual advertising on REA when house prices are falling? You know, should a company like this do badly because the house price sector is under pressure? I think you'd be surprised at the answer, and you might actually understand why REA's share price has been doing well and might continue to do well. So that's the show. Let's kick off now with Marcus Bogdan. Thanks for joining us, Marcus.
Good to see you, Peter.
All right, so big news overnight. US inflation came in less than expected. Wall Street reacted very well. Tech stocks have a nice rise. But do you think this is the kind of data drop that is going to help this market eventually get into a solid uptrend over the next 3 to 4 months?
It's an important metric to have that inflation fall and start to stabilise in certain components there. The other key metric that we're looking at is the significance of supply constraints in the supply chains also improving. And I think the third element that will drive markets has been a better than expected Q2 earnings season in the US. It wasn't nowhere near as pessimistic as some people were forecasting. And then what we're seeing in Australia with the results season so far, very benign results from the banks. And today, an uplift in Telstra's dividend. So I think all of those things are broadly supportive of markets moving forward for the rest of the year. Certainly challenges. I mean, inflation at 8.5% is still problematic, but if the trend can continue to see some further reductions there in inflation, whilst earnings remain relatively sound, I think they're very important underpinnings for the overall market.
Yeah, and inflation is the change in prices. So even though prices have gone to a high base, a lot of those prices will probably fall by the time we get to our CPI, which will be a September CPI. Now that gives us July, August, September. Across those 3 months, oil prices are likely to be heading down. We've seen quite substantial ones. So it could well be that September number could be better than has been tipped even by Treasury and the RBA.
Quite possibly. We've certainly seen that in commodity prices broadly coming off. And I think you'll start to see it on the good side as well. Offsetting that is on the services side, which is a very important component of the economy, and also we're still seeing strong employment and wages. But I think that the heat, certainly the key heat in inflation, has started to moderate, and that is certainly a good thing.
Yeah. Okay. So, given what you've seen, is it in any way changing your investment strategy going forward?
Not at this stage. I think we want to be in the highest quality companies on the Australian Stock Exchange. And we're really focused on quality and those defensive characteristics. I think what you might be leading to, are we pivoting the portfolio more towards sort of growth stocks? Not yet. We think that those valuations are still too high, particularly when you look at it from an historical perspective. And I do think that they will continue to be challenged by higher discount rates. I think the other thing that we haven't sort of commented on is just the trajectory of interest rates. And obviously, as they are moving forward, still in an aggressive mode, that could temper the markets somewhat.
Yeah. So if you want to, why don't you give us an idea of a company that you've maybe recently added to the portfolio and tell us why you did it?
Well, we have tilted the portfolio more into telecommunications for a number of reasons. Firstly, the defensive nature of their earnings, the fact that they've been able to put, and Telstra have alluded to this in their result today, they've been able to increase prices at the rate of inflation for their mobile business. That business is going extremely well as the industry leader. And thirdly, the dividend outlook looks stable to improving, and Telstra have increased their dividend for the first time since 2015 today. And I think that that's a positive indicator. And the final element is that both Spark and Telstra have got significant infrastructure assets which they're monetising, which not only strengthens the capital position of those companies, but also provides further support for growth for those companies going forward.
All right, so that's a company you've added and the reasons for it. Are there companies that you've got on your short list that you aren't ready to buy now, but at a point when you think growth stocks are going to have a good run, what kind of companies are on your short list?
Well, it's actually in two parts. So we've got growth stocks and we've got cyclical stocks that are potentially on the watch list. And both of those, require some sort of stabilisation or knowing where the end point is on these interest rate increases are. So on the growth side, there are companies like Xero that we're watching carefully. On the cyclical side, ones around building materials, companies like James Hardie or Brickworks that have got a strong history of earnings delivery, but we just need to be able to see some stabilisation in the end markets. And if there is a soft point in the US economy, it's certainly been the downturn that you're seeing in the US housing market. So we'd probably like to see some signs of stabilisation there before we got really enthusiastic on the cyclicals.
This week, a company like REA reported. Is that the kind of company you would at least run your eye over if you thought that the current price was, a consequence of the expectations of lower house prices, but you may well believe that out there could be a housing recovery eventually?
Yes, in another portfolio where dividends are not so imperative, we do have an investment in News Corp, and News Corp is the largest shareholder, 60% owner of REA. And REA has been an extraordinarily successful business and actually navigated very well through the global financial crisis, given the breadth of services that it had. So that is an absolute leader, and I think that will continue to show continued resilience as a very high quality digital property play. But the dividend yield is quite low, and so that has to be made up by better than expected earnings growth into the future.
In your portfolio, are there companies that will do better or worse with a rising Aussie dollar. And the expectation is US dollar will fall over time as they aren't going to possibly raise interest rates at the same rate. If that was your scenario, are there stocks that you think are currency sensitive and make you either buy them or sell them?
Well, certainly. I mean, the exchange rate is quite interesting given how high commodity prices are. The Australian dollar at around 69.70 cents is comparatively low. If you look at the history since the Aussie dollar deregulated in the 80s, there are companies that are highly sensitive to the exchange rate movements, particularly in some of Australia's largest companies, whether it be resources, whether it be companies like CSL, Amcor, or Brambles. Those are either tailwinds or headwinds for those underlying businesses. But I think the important thing is that we try and look through the currency and look through the underlying growth rates in those types of businesses. BHP is obviously benefiting from extraordinarily strong terms of trade for Australia and the trade surplus that we have at the moment, and then companies in the sort of industrial defensives, Amcor, Brambles, James Hardie, with significant operations in the US, are quite sensitive to movements in the exchange rate.
One last one, you hold BHP, and obviously it's been a great dividend payer. Is your expectation over the next year that the BHP share price will go up or go down?
Well, it's at the sort of the bottom end of its trading range at the moment, and there has been a moderate recovery in the iron ore price. It's around $111 today. It got down to about $100, and both all of the iron ore producers are still making incredibly strong profits there. Rio's recent result did see a reduction in their overall earnings because there has been a pullback in some of the key commodity prices in the short term. And I think BHP, they've made an offer to Oz Minerals, which I think is strategically important. It makes sense in terms of that increasing that exposure to copper and nickel. But it may mean that they are more conservative in terms of their capital management plans, in terms of either buybacks or dividends. And you saw that conservatism in Rio's most recent result, where the payout ratio was around 50%. So the underpinnings for BHP still remain incredibly sound, robust balance sheet. The pivot towards copper and nickel certainly makes sense. And I think that over the next decade or so, the decarbonisation and the requirement for minerals will see very strong demand for their underlying commodities.
Yeah. So do you think BHP will have to make another offer to win Oz Minerals?
Well, they've flatly rejected the $25 level. And look, these things take, there's generally a long tail in these to engage the underlying company. And so I think, this is obviously the first iteration, and we'll just see how that pans out going forward. But certainly from Oz Minerals' perspective, it was absolutely opportunistic from BHP's perspective, given the weakness that we've seen in copper. But we do expect to see a higher price going forward.
Great. Thanks, Marcus.
Terrific. Thanks, Peter.
That's Marcus Bogdan, the fund manager of the Switzer Dividend Growth Fund and the founder of Blackmore Capital. Well, as I pointed out earlier in my introduction, US inflation has come in better than expected and the market has liked it. Paul, is this another sneak preview of what's going to happen when inflation really is under control and interest rate rises are over?
Look, I think it is, Pete. I mean, this is what, if you go back, what caused the market back in January and February to get the nerves, and really what started the sell-off was all about the fear of inflation. I mean, we didn't know about the Ukraine war back in January, but we still were getting there was still some reads, people saying inflation was going up because of supply chain.
Yeah.
And then we had the Ukraine war on top of that, which then obviously changed oil prices and food prices and added to the fear. But what we've seen all the way up is inflation has been rising more quickly than people feared. And the central banks have had to be more aggressive. And now you start to get a sense that, well, maybe inflation is peaking. This is the first number that's come in better than expected. And maybe people will start to say, I think that, well, the central banks, they don't want to quite tip the world into a recession.
No.
But they need to slow it down, which to do. And it's too early to say it's slowing down, but as soon as that inflation starts to moderate a little bit, they're going to be a lot less guarded in terms of less circumspect about putting too much pressure on increasing rates too fast.
Yeah, and I think what we look forward to now is the August number. Hopefully it'll bring a 7% type inflation number. And also what I looked for this morning and was happy to see was when you break up what is inside that consumer price index, rent prices, car prices, gasoline prices, and all those sort of prices, they're all trending down, or most of them are trending down. And that's a really good sign, I think, for future inflation. And that's why the market's happy. And that's why tech stocks have had a really good day, haven't they?
They have had a good day, great day in the US. Not Australia's sort of still behind, I guess, but we're sort of behind a lot in this market. We never went down as well. We didn't go down as far initially, and then we went down even harder. And then the tech stocks have bounced a lot more in the US. I guess we're now sort of caught up a bit in reporting season. But I mean, look, I think overall we've sort of tech's such a small part of our market anyhow. When we've had more support for the banks and the BHPs of this world, that we probably got lost a little bit in that. But I mean, it's a good performance day on the tech side. And I mean, I think you're right. I mean, this is a really, as long as we don't think this is a one-off, this is really important, and it's starting to look like the US market bottomed back in June. That's what it's starting to look like. Now, maybe it's too early to call that. Maybe we see it test again.
Well, that was going to be my next question, Paul. I don't want anyone to think that, okay, it's up and away in a straight line. There will be profit takers, won't there? There'll be people taking the punt. Okay, I bought the zip at 60 cents and it's now $1.40 or something. I'm taking my profit. Why wouldn't you? But the underlying force of the share prices going up is the belief that interest rate rises aren't going to be as bad, aren't be as high as was expected.
Yeah, and look, and I think just again, sort of Matt Common sort of confirmed that from the CBA. Now there have been a CBA, this is just bring the debate back to the local level. I mean, we're going to follow the US, but let's look locally. A lot of people in our market have been thinking the RBA was going to keep going 0.5%.
Ridiculous.
CBA's been a bit of the outlier.
They were.
But they're still an outlier. But, I guess the data's coming around to their side. And remember, driving our central bank has been just, I would think, follow on. So much market pressure, they've been behind the eight ball. Now when the market starts to sort of sense, well, maybe they don't need to push it as far. It's going to be easier for them to take the brakes on. So I think they've probably got to say that we won't see 0.5% in September. We might see just a quarter. And the CBA view might be closer to where the cash rate is going to be at the end of the year than perhaps the market had feared. So that's important locally.
So we're at 1.85. So even if they did one last 0.5%, and they could be talking about, let's do this and then not do it for a couple of months. That would have us at about 2.35, was where I think CBA were expecting the cash rate to be.
I think they're sort of probably maybe 2.6-ish, I think.
Okay.
I think
that's
sort
room for another
maybe
rise.
0.75% between now and year end. But there are people calling, as high as,
3,
another
3.5,
3 and
4.
3.5. So markets like to get ahead of themselves. So look, I don't know whether they're quite, the timing of this, and you're right, maybe we get something in September and then we get a couple of months and they wait and see. I mean, it's been a really steep, increase, right? It's only just flowing through. It takes a long time to actually get, for borrowers to feel the impact. So.
And remember, not everyone's got a home loan.
No.
So if you haven't got a home loan, you still got your job, You're still out there buying airline tickets to everywhere. And one last one, Paul, then is, if you put all this together then, are you thinking that our market is going to stay effectively creep higher over the next 6 to 12 months?
Look, I'm actually, let me rephrase your question a little way. I think reporting season's going okay so far. When I say going okay, what I feared with reporting season was not so much the results, but I thought we'd see more conservatism from companies, outlook statements. And to be honest, look, there's no upside being a director, I can assure you, right? Yeah. So, and there's no upside being a CEO. So when everyone's talking about the world going to, you've got China, or you've got Taiwan, you've got oil prices, you've got Ukraine, there's a lot of uncertainty out there, right? Yeah. And so I expected people to be a bit more conservative. But if you look at the actions, right, and particularly in terms of dividends, right? Telstra one today, I think, is quite positive. CBA, it was a little conservative, but it's an increase. They're probably going a little more than I expected, and I haven't seen this sort of super. We really don't like the world. Could be really tough the next 6 months. So we're really reluctant to tell you how we're going to go. You haven't quite seen that conservatism. Now it's early days. But I'd say that's a little more positive for the market. The results are sort of, they're okay. There's nothing really stood out so far. REA was good, but they're not quite seeing the conservatism on the outlook statements I expected. So early days.
So let's just say we're not in the business of picking an individual stock right now, but if we weren't, for the person who doesn't want to take the punt of, going for a Zip or a Tyro or a Megaport or whatever, from here to Christmas, playing an ETF for the overall market, not a bad idea.
I think 7,000. I think you and I still think it's more likely 7,500 by the end of the year.
Yeah.
An ETF will lock in 5 or 6% plus 2 or 3% dividend return.
Yeah.
Look, there's going to be a cheaper time to buy it. This won't be the bottom of the market. No. I still think this year could end up positive overall, right? We started about 7.5, we went down to about 6.5. Not as bad as the US.
Yep.
We're back at about 7. We've got to see the continuation. The inflation theory that has peaked has to work through the system. We have to see that, but you and I always argued this was more transitory than and there are other forces at work. But you're out there today, sort of saying this is really good news in the US. I think you're right. Want to see it continue, but I think that's one way to play it if you're not a thrill seeker. And
there is that old saying, Paul, sell in May and go away, come back on St. Leger's Day, which of course is in September.
Just put normally they're the scary months in the market, right? So maybe this year might be a little different, right? Yeah. June is normally a good month, or June, July. So
October, November, December should be a good time for being in the market. Let's hope so. That's Paul Rickard of the Switzer Report. Well, soon I'm going to be interviewing the senior economist at PropTrack, which is a business that's owned by REA. And ahead of the interview, I thought, let's have a look at what's been going on with the REA stock price. We have actually been saying on this program that the good quality tech companies like REA, carsales.com, those sorts of companies really are the ones that will probably be bought first when tech stocks are forgiven. You can see on here that there actually has been a high of REA of $187. It's now $129. But the recent low, with tech stocks being sold off, it went down to around $95. And since then, there's been a 36% rebound. So those people who listened to us when we started talking about, buying quality tech stocks, and I think Junbei Liu and I think Julia Lee were two experts who liked the idea of buying the quality tech stocks a few months ago. They've really given us some really good indications. Now, I'd like to have a look at what the analysts are saying on FN Arena. And the table in front of you shows you that. There's 7 analysts there. Running through, there are 2 that aren't all that keen on the stock, but the other 5 outperform, buy, add, buy, upgrade to buy from neutral. So 5 out of 7 analysts still like the stock. The average rise is 3%. That 3% comes from adding up all of the rises and falls in that end column. But if you have a look at that end column, a company like Macquarie is very negative on the stock, 31.96% downside. But a lot of other analysts are very positive. You've got Credit Suisse, 9.79%, Citi, 18.6%, Morgan's, 11.33%, Ord Minnett, 12.11%. So there are plenty of people who still like the stock. And so what I want to do is ask Eleanor Creagh about the behaviour of people when house prices fall. You know, do they keep looking on websites like REA? Do the ads stay in there longer? And so potentially, can REA do well during a period when house prices are falling? So let's just see what Eleanor has to say about the future of house prices, and we'll try and work out whether that's going to be a positive or negative for REA, the stock. Well, joining me now is Senior Economist at PropTrack, and that is Eleanor Creagh. Eleanor, thanks for joining us.
Thank you for having me.
Tell us what you and your team at PropTrack are seeing for house prices over the next year or two.
So certainly as interest rates have risen and risen quickly, housing market conditions have deteriorated and prices have quickly began to fall in some parts of the country. So the PropTrack Home Price Index is showing that currently national home prices are down 1.66% from their peak in March. Now we are expecting those price falls to continue as interest rates continue to rise. So we're expecting a range of around -9 to 15% price falls by the end of next year. But there are some, I guess, key kind of uncertainties there in terms of how far and how fast the cash rate really does truly end up. And of course, how much or what the profile looks like for the deterioration in household spending as interest rates continue to rise quite quickly. How much is that going to be offset by tightness in the labour market, job security and wages growth, which will clearly play into the profile of how high and how fast the cash rate can continue to rise, and of course, how large those housing price declines are going to be.
Yeah. Is there a measurable development when interest rates rise certain percentage sizes and how prices react? So I'm saying, if there's going to be another 1% rise in the cash rate, does history give you an idea of how prices respond, or is it too different period by period to come up with a confident and accurate guess?
So certainly the RBA does have a forecasting model that outlines when interest rates rise a certain number of basis points to expect an X percentage of price falls in the housing market. But we've actually done a little bit of a look back at past housing price declines. And there are various other factors that kind of play into, I guess, how far and how fast home prices can fall when we do enter that down cycle in the market. And looking back to 1990, we've actually only seen 5 periods when nominal home price growth has ended the year negative in year-ended terms. Now, a lot of those periods have been slightly different. So the last kind of large outside price falls that we saw were in 2018-19, when we saw macroprudential policy really tightening and putting a dent in the housing market. But this period was also accompanied by a period of the labour market weakness and weak wages growth. So we're approaching a period that's a little bit different. So we know that the unemployment rate is the lowest it's been in 48 years. Yep. The labour market is tight, and we are expecting stronger wages growth to materialise. And hopefully that will offset some of the impact of this fast pace of rate rises. I think it's also important to note that when we look at historical price falls Australia-wide, We've throughout those 5 periods where year-ended price growth has been negative, looking back to 1990, those price falls have actually never been larger than 10%. That's obviously a little bit different when we drill down into the different capital cities, like Sydney, Melbourne and the likes. Sydney did see price falls of just over 10% back in 2018. But again, when we look at some of the kind of forecasts that are on the table at the moment in terms of seeing maybe 30% house price declines, although history is no predictor of the future, when we look back at previous housing market cycles, we haven't seen such outsized price falls.
So does that make you want to see headlines like 30% house price falls? Bullshit.
Look.
Of course, I am joking. I am joking, but you probably are asked the question. Probably that 30% fall looks a little bit over the top.
Yeah, look, I mean, it's certainly not what we're forecasting. We are forecasting that house prices are going to continue to fall as interest rates continue to rise, and that those price falls will kind of broaden and accelerate. So far, we've seen that it's really the more expensive markets, Sydney and Melbourne, that are leading the price falls. So both Sydney and Melbourne are down more than 3% from their peaks. And we do expect that Sydney and Melbourne are going to continue leading the price declines. We've seen so far that the smaller capitals, Brisbane, Adelaide, have been a little bit more resilient, although last month the PropTrack Home Price Index did show that we did start to see those price falls coming into play in Brisbane. Adelaide so far remaining a little more resilient, and we do think that that picture is going to kind of continue over the next 12 months or so, but certainly we are expecting prices to continue to fall. It's just those kind of 30% forecasts, potentially not.
Okay, so is it fair to generalise that the cities, towns and suburbs where they had the mega rises, and I'm thinking towns, Byron Bay, suburbs, some of the seaside suburbs of Sydney and Melbourne, if they've had rapid price rises, is it more likely that they'll have bigger house price falls, or is that too simple a generalisation?
No, look, I think we have seen that it's largely the upper end or the high end of the market, so the more expensive suburbs at the moment that are seeing larger price declines. So we talked about Sydney and Melbourne at the moment being down more than 3% and kind of leading those price declines. But within Sydney and Melbourne, you're right to point out it is a lot of the markets that very much led the upswing that are seeing larger price declines at the moment. So when we look at Sydney, thinking of suburbs within the Northern Beaches, also the eastern suburbs. So when we've looked at the kind of decline in values over the last 3 months, we've seen that it's suburbs like Palm Beach, Tamarama, suburbs within the Central Coast, and also the Mornington Peninsula. So those lifestyle coastal destinations that were very much in favour at the onset of the pandemic and really saw very outsized price increases are now kind of bearing the brunt of the value declines. And we're certainly seeing that that top end of the market is falling at a faster pace.
Okay, great. So I might go out and start bidding for houses at Tamarama and those areas. No, just joking. Now, all right, so what I'm really interested in is, given what you've suggested, is there a natural belief that when house prices fall, that it becomes difficult to sell properties, or as house prices fall, does the supply of properties coming on the market and listed on REA, do they tend to increase because people get a bit worried, oh, it's down 5% now and they're talking 15 or 20, I better get my property on the market and try and sell before the worst happens? Is that a typical behaviour of potential sellers?
So we've seen at the moment that new listings have continued to be very strong on realestate.com. I think there's a kind of number of factors coming into play there. So clearly house prices have only just started to fall, and there are expectations of further price falls. But also we are continuing to get a bit of an overhang of people that potentially held back last year when restrictions were in play, and we're still getting that strong flow of new listings coming to market. But we are seeing that potential buyer demand or prospective buyer demand from people kind of searching and looking at properties on realestate.com.au has pulled back as interest rates have moved sharply higher and borrowing costs have risen. And we've seen that flowing into kind of a weaker auction market. Auction volumes have fallen, auction clearance rates have fallen, and also sales volumes have fallen as well. So when we look at the month of July, across Sydney and Melbourne, so sales volumes in Sydney are down 30% in July compared to July last year, and in Melbourne down at 29% when we look at July last year. So clearly we're getting to that point where, although we've got a strong flow of new listings coming to market, transaction volumes are slowing, and we're kind of approaching a scenario where the total availability of property, or the total stock of properties on the market, is rising. Now, for some people, that could actually present a bit of an opportunity, right? So for buyers throughout much of last year, there was a real sense of urgency, a fear of missing out. It was pretty hard, I think, for a lot of people to find the right property for them, because we consistently saw that the level of new listings was very constrained. And there was a really tight supply of properties available for sale. And now we've got a lot more choice. So there's a lot more opportunity to find the property that you're potentially looking for. Now, where that is a little bit different is the regions still. So we continue to see that although the availability of properties for sale has picked up slightly in recent months, there still is a pretty constrained availability of properties for sale. And even though demand to buy in regional areas has dropped off as interest rates have risen, we've still got that kind of imbalance between supply and demand in play in many regional areas.
Okay, so is it fair to say then, there's probably going to be a sort of a transitional period where a property that may well have been on REA for 4 or 5 weeks before selling, it might be on there for 10 weeks until they either withdraw it from sale or accept a lower price?
Yeah, and I mean, we are starting to see that properties are taking longer to sell. So we've seen that days on site across all the capital cities have picked up off their record lows. And have continued to kind of rise month on month throughout this year. Now, there's a few factors playing into that. It is, of course, the fact that there is a lot more choice out there. So buyers don't really have that kind of sense of urgency, that fear of missing out, or that really tight competitive nature that characterized the market in the upswing is no longer there. So that, of course, is meaning that people have a little bit more time to make decisions, and properties are sitting on the market a little bit longer. Now, that is something that we are expecting to be a lasting trend throughout this year, and certainly as consumer confidence has slipped, buyer demand has pulled back a bit, and I guess people are feeling a little bit more hesitant, a little bit more uncertain about where future borrowing costs are going to be, certainly than those prospective buyers over the last 2 years or so. And with this continued influx of new listings that we're seeing, we are expecting that properties are going to continue to take a bit longer to sell.
Eleanor, thanks for joining us on the program.
Thank you for having me.
Well, given what Eleanor Creagh said about listings being likely to be on the website for a longer period of time, and also the fact that they're not as negative about how serious the house price fall might be, it kind of augurs well, I think, for the bottom line for a company like REA in terms of profitability, and ultimately that should be a positive for its stock price. So going back to those analysts, 5 out of 7 were giving the company a thumbs up. Maybe I'm more keen to be an REA supporter than not, though I do have to say it was a much better buy around June 17 and beyond. But still, I think this company still has a few legs to go, and given the fact that it had a much higher share price in the not too distant past, it probably has potential to go up a little bit more. And that's the show for this week. Thanks for joining us. Don't forget we are back on Monday. And if you want to know more about the kind of stocks that we look at, have a look at the Switzer report, switzerreport.com.au. Thanks for joining us. See you on Monday.